Welcome to my channel. I'm the cover call guy, and my goal is to create $120,000 per year passive income. As of right now, my portfolio yields, it is actually incorrect. It's $71,000 a year and a little bit over 6,000. And I'm going to be achieving my $120,000 per year passive income using only cover call ETFs. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online or today, and I could be completely wrong. With that out the way, let's get started. Today's video is going to be about macroeconomics. Japan actually broke a record today. The 30-year Japanese government bond yield reached 3.32% or 3.35%, depending on the sources. It is the highest level in history, and you're gonna be like, well, I'm not Japanese, or I don't live in Japan. How does that affect me, right? I'm an American, right? But Japan is the fourth largest economy in the world, and if their rates go up, it affects everyone. It is very intertwined in the global market and is very intertwined in the U.S. global economy. So if Japan starts choking, everyone will feel the suffocation, right? So we're just going to talk about what's happening in Japan and then how that can relate to some cover calls. And I'll mention something else besides cover calls, buffer ETFs and some defense derivative ETFs. So yep, let's just see if you guys hold this. If you don't hold it, if you're interested in something outside of cover call ETFs that is similar but offer a little bit more hedge and protection, this video is for you. And it's just, and if it's nothing with that and you just want to learn about what's happening in the world, this video is also for you. I don't just do cover call ETFs. I try to kind of cover everything financial related, and sometimes rants about financial. Well, anyways, let's get started. The macro paradigm shift, the transition from zero interest rate to a sustained high yield regime has dismantled traditional safe havens, right? So financial claustrophobia, rising rates exert dual pressure. One, it erodes bond principal, which is the duration risk, while compressing equity valuations, which is the discount rate, right? The 60-40 portfolio correlation has been broken. I talked about this a lot. I think the 60-40 portfolio is kind of becoming outdated and obsolete. And if you don't know what the 60-40 portfolio is, it's basically 60% growth, and then basically like 40% bonds or in other mix. And I don't think that's I don't think that's going to be working more. It worked well with boomers and maybe Gen X, but for the younger millennial and Gen Z, I don't think this is going to be work. I don't think this portfolio is going to be sustainable in the future. A lot of things have changed, right? Money has become so devalued that, I mean, bonds, and I personally would just never touch bonds, even if I get older. I think I would just stick with actual stocks, real estate, and maybe open up in a business. But I think I'm staying away from bonds unless it goes into a double digits. But I don't know if the Fed's gonna ever rate to double digits. I don't know. I could be wrong though. But anyway, this is important for Japan and important for the rest of the world, because this might be the catalyst. Japan's 30-year bond yield breached a 3.3%. That's the first time in history ever to do that. Signals a structural end to global cheap money, forcing a migration towards derivative enhanced strategies for defense. So as you know, as the rates starts getting cut for the U.S., that means money is becoming cheaper. However, inflation is always also going up. So it's like it's not even a double-edged sword. You're cutting yourself both ways, no matter how you touch it. That's very, very risky, right? Japan's yield surge, the 1-year delta, November 2024 was 2.27%, and then November 2025 was 3.32%. A 41 increase in risk-free yields fundamentally reprices all global risk assets. And remember, they're the fourth largest economy. They're either the third, fourth, or fifth. I gotta double check. I think the last time I read out, they were the fourth. So a lot of this matters, and it's going to impact U.S. stock markets and U.S. economy. All right, systematic risk of the yield surge. So risk for Japan, unsustainable debt, debt to GDP ratio is 260 times, which is it's insane, right? The U.S. Debt is like what 38.5 trillion, and we're reaching there. We're getting close to. I think we're about 50 to 60% of ours, so it's not as high, but it's starting to become unsustainable for the United States also. Fiscal concerns. Investors are worried of expansionary stimulus funded by increased bond issuance, because then it becomes worthless. You're never ever going to see your money back, or it's just you're going to lose money buying bonds. A weakened yen, instability fuels inflation via import costs and encourage carry trades that can unravel abruptly. So again, guys, I don't know about you guys, but the only cars I ever buy is Toyotas and Hondas, and those are gonna go up in price. So if for the American consumer, the prices of Toyotas and Hondas are already going up. The base model just in 2019 used to be like 25,000. Now the base models are like 45, 50. Go search it up. I'm not lying. Anyone from 40 to 50 is that damn near doubled. So it's only gonna get worse, and it's for like a base model. Now imagine a luxury, right? The luxury is already pushing over 90, $100,000 for a goddamn car. And then a pension, of course, the people that of Japan, the Japanese people is gonna feel the pinch, and the whole thing just slides, right? Then they don't spend, and there's a whole circle, no spending, the money flow stops, right? And then risk for global markets, interest rate contagion. Of course, the U.S. depends a lot on Japan buying U.S. treasuries, right? So then it's going to start end up driving global rates higher, and not a lot of people is going to want to buy U.S. treasuries, because we become untrustworthy without that too, right? And then there's something called the carry trade unwind. A rapid unwind of cheap yen bond could trigger a widespread sell-off in global risk assets, which is what we might be possibly seeing the past few days also. Of course, people see this happening and they start selling off, stocks. Tightening conditions, the loss of Japanese low-rate anchor tightens financial conditions globally, weighing on economic growth. So if Japan's growth slow, so does the United States, so does everyone else. Active cover calls, the broad market, right? The evolution of passive at the money writing to fundamental screening and dynamic overlays. So these are at least 3 cover call ETFs I think will do quite well in high turbulence and just uncertainty, and that'll be JEPI, right? It's a very defensive stock, low volatility. The beta is lower than S&P 500, ideal for capital preservation. And then GPIX from Goldman, and has a very strong dynamic call writing, so it can adjust the coverage based on volatility signal to capture recovery side. And then Devo from Amplify, it use tactical single stock call writing on the high quality dividend growers. So the high quality dividend companies, you're always you need to use the bathroom and wipe your butt, right? So you're gonna need toilet paper, right? So buy P&G or whatever company supplies it. So I don't think that's ever going away, right? So people get sick, people need to brush their teeth. People will brush their teeth, no matter the economy, right? So you buy high quality companies that grows the dividends. So I think Divo would be a strong contender here. These are just 3. I mean, I have a lot more, but I just put 3 because obviously the slides doesn't have enough space for me. And then structural innovation, such as SPY-I and iSpy, right? SPY-I has good tax efficiency, and so I think because of their strategy, it doesn't cap a lot of the upside. So in a very volatile market, if it jumps up, SPY-I can capture on that. Plus, it's very tax efficient, and iSpy has daily resets, which is just kind of pretty much SPY-I, but it does the daily resets. And the only difference is that SPY-I is from Neos and iSpy is from ProShares. And then the value factor fortress, right? So in rising yield environments, shorter duration value stocks historically outperform growth. For example, DJIA Global X Dow Cover Call and Dog. Some of these I know it's not talked about a lot, but these are some of good contenders to think about if you guys are worried about the global economy, because a lot of things are slowing down. As you see that the labor market in the U.S. is not so great. Yeah, nobody can really get jobs, and if you could get jobs, it's not like the high paying or career type of work. So just a lot of things to look into, and a lot of things to test out and see what you want to buy. I know a lot of people buy the ultra high yields, but in terms of uncertainty, you want to start lowering the yield because it's more stable, it's more reliable, it's more consistent. Something to think about. Then we talk about the buffer ETFs. These are not cover call ETFs. These are buffer ETFs. They are more in the name buffer, like hedged. They're more strategic. They're more defensive in nature. The high rate advantage is that high interest rate massively improve buffer caps. Higher yields on collateral assets such as treasuries give managers a larger budget to buy upside. Caps have expanded from 8% in 2021 to 18% today. The latter strategy, which is BUFR, from First Trust and Buff, which is Innovator, invest in rolling ladder of monthly buffer ETFs. This diversifies timing risk and provides a perpetual buffer profile, smoothing entry and exit volatility. So these are some of the two ETFs you can look into. I'm really thinking about adding at least one into my portfolio. I am very concerned about how inflation is really starting to take hold and actually not go away. So unless there's something has to break, right? Something has to break. The housing market has to break. The labor market has to break. Inflation has to break. Global supply chain. Something has to break in order to reset it and lower everything else. And the gas has to, something has to break. So I want to play some defense because right now I have a lot of offense. Right, and then there's the ultra buffers, right? The bear defense, UJAM, UFEB, designed for hard landings, protect against losses from -5 down to -35. Unlike standard buffer, these are catastrophic hedges that sacrifice the first 5% to shield against the crash. So I really like these two, just because of how defensive it is, and I like playing defense, right? Because you don't ever have to worry about the red days if you have a good solid portfolio. In fact, you brace for them and you embrace them, and I like them. So I like to play some, at least like 10% of my portfolio into defense, which I'm starting to look into, just for the rainy days. And then we have the uncapped outcomes, NOVS, right? Structured to capture 89% of the upside with no hard cap, while buffering against 8 to 10% downside, ideal for investors who fear missing a soft landing rally. So it's not as crazy as the ultra buffers, but it's something to think about if you guys want to play some hedge, want to have some downside protection. Some of these are to look into. Right, sector specific defense, right? You have utilities, real estate, and energy. So these are just 3 different sectors. You always want, I personally like to be diversified and have one ETF in like a specific sector. I like to just kind of get my hands on everything. I like to just get my toes dipped in every sector. That way I'm not really missing out if one were to have a crazy bull run over the other. I kind of, I'm equal in a way. Cash and short duration, the ultimate defense balance with zero duration risk. CHI from NEOS, enhanced cashed, holds 1 to 3 months T-bills plus sell put spreads, generate 100 to 150% base points above risk-free rates with near zero duration risk. And then there's high, simplify income, enhance income, short dated put calls spread on diverse assets plus T-bills, uncorrelated income engine. And then there's also Mint and JPST. The one I really like right now that I have my dry powder is CSHI. I really like Neos, and I just stuck with them. So having my dry powder just kind of held steady with CHAI right now. And the collar strategy, right? Which is, I nicknamed it the floor, right? Buying protective puts financed by selling calls to establish a hard floor and losses. And some of them that do these is NUSI, that does the NASDAQ, XRMI, Global S&P 500, XCLR with the SP 500, right? So some of these are just hedges, and they protect against some losses, and they try to hold steady during a very, very volatile time. And then, of course, commodities, inflation. If you wanted to get into gold, there's GLDY, GLDI, USG, and then silver, SLVO, which is a very, very, very popular one. For me, I don't hold any gold or silver ETF. I prefer to actually buy the physical gold and silver. I like buying the coins. I like buying the necklace, the jewelry, the rings. So that's what I do. I buy the physical commodity. I'm not really a big fan of the commodity ETF, just because, I mean, there's nothing wrong with it. I guess I'm a little old school in my mindset. I actually like having the jewelry and making something out of it, wearing the chain. For me, it's also easier to kind of sell on a spot if I ever need the cash. But yeah, I like having the physical asset for these two. And then my verdict, the cover guy's verdict here, right? The era of easy yield is over. You need defense, right? Core defensive income, somewhat JP and SPY. The sleep well at night, BUFR and CHI. Tactical rotation, XLUI and DJIA. And then, of course, avoid the yield traps for now, right? The yield max and the QYODs, right? Don't chase the 50% in a falling market, especially in very, very unsustainable uncertainty times. You want to have a well-rounded portfolio, because we don't know what's going to happen. This could be the start of a prolonged bear market, and you want to be able to sleep well at night with a nice tactical rotation and some core defense. If you guys don't start looking into it, I always encourage, especially the new investors, don't go in the full offense, right? You want to have at least 10% of your portfolio playing the defense. That way you don't crash like 20-30%. That's gonna be devastating for you guys. For the new ones, it's gonna be devastating for your emotional and mental and spiritual health. That might make you panic sell, right? We never ever want to panic sell. I've never panic sell before, just because I've always kind of bought higher quality stocks and ETFs, so I had no reason to ever sell, even if it went down. My first big bought was like the 2020 dip, and that made me easy. That made it easy for me to withstand like a 10, 15, 20% drop, because I'll just buy the dip again. And hopefully you guys will buy the dip also. Don't ever panic sell, especially if you're holding quality stock in ETF. You're holding good companies, right? There's no reason to sell. You're giving away cheap shares to someone else who's building up. So they're taking away your gains. They're taking away your generational wealth. Don't ever do that. Yeah, so this is my verdict here. I hope you guys learned something, agreed, disagreed. Thanks for watching. Don't let the yield quick shake your portfolio, right? I know Japan is going to go through some economic times, and it's going to shake a lot of economies. If you're in the United States and American like I am, we're going some tough times right now. Inflation is still kicking our ass. The labor market is in total free fall right now. Yeah, we're gonna be going through some tough times. I could be wrong. I hope I'm wrong, but I think the worst is yet to come. And once we get through that, man, we're gonna see some big grain. I can't probably say it on YouTube, but We're gonna see the big green, big thumbs up, and it's gonna go smash our portfolio all the way up, and it's gonna help us retire. Thanks for watching, guys. Stay tuned for the next